Hey everyone, in today's video I'll show you how to calculate cost of goods sold in Excel. This is an essential calculation for tracking your product-based business performance. Let's jump in. The formula we'll use is, this tells you how much it actually costs to produce or purchase the goods that you sold during a period. Press Enter, and then drag the fill handle down to apply it for all months. Each row now shows the cost of goods sold for that specific period. This value tells you how much inventory was actually used or sold during the month, a key part of calculating gross profit. If this video helped you, don't forget to like, subscribe, and hit the notification bell so you never miss a new Excel tip.
Hey everyone! In this video, I'll show you how to calculate value-added tax. Type equals, then select your price before value-added tax, then multiply it by 1 plus VAT rate. And we receive $1,200 as the total price. Now, if we want to calculate the price before VAT, let's say those $1,000 include the value-added tax. We need to write the same formula, but instead of multiplying, we divide. This will give us the price before value-added tax, which is $833.33. I hope this tutorial was helpful. If you enjoyed it, please give it a thumbs up, subscribe for more Excel tips.
Hey everyone! In this video, I'll show you how to calculate markup in Excel. Markup is the percentage increase from the cost price to the selling price. It tells us how much extra we charge over the cost to make a profit. To calculate markup, start by subtracting the cost price from the selling price to find the profit amount. Next, divide the result by the cost price to determine how much percentage is added over the cost. Now, hit Enter, and Excel will calculate the markup. To display it as a percentage, click on the % button in the toolbar. That's it, now you can calculate markup in Excel easily. Let me know in the comments if this helped, and don't forget to like and subscribe for more Excel tips. Hey everyone! In this video, I'll show you how to calculate yield to maturity in Excel. To calculate yield to maturity in Excel, we use the rate function. First, we select the number of years until maturity. Next, we select the annual coupon payment the bond pays. Then, we select the current market price of the bond. Since this is an outgoing payment, we add a negative sign. Finally, we select the face value of the bond, which is typically $1,000. After entering the formula, press Enter, and Excel will calculate the yield to maturity. This allows us to determine the bond's return if held until maturity. That's it, now you can calculate yield to maturity in Excel easily. Let me know in the comments if this helped, and don't forget to like and subscribe for more Excel tips.
Hey everyone! In this video, I'll show you how to calculate the compound annual growth rate. Let's say we have a beginning value and an ending value for an investment, and we want to find out the average annual growth rate over a specific number of years. In a new cell, enter this formula. This divides the ending value by the beginning value, raises it to the power of 1 divided by the number of years, and subtracts 1. To make the result easier to read, go to the Home tab and click the percentage button. For our example, the result is 14.87%, meaning your investment grew at an average of 14.87% per year. That's how you calculate compound annual growth rate in Excel. It's a simple way to measure your investment's performance over time. If this helped you, like and subscribe for more quick Excel tips. Hey everyone! In today's video, I'm going to show you how to calculate return on investment using Excel. It's one of the most important metrics for evaluating how well an investment is performing. It's expressed as a percentage. Imagine you bought 100 shares of a stock for $50 per share, so your total investment cost was $5,000. A year later, you sell all the shares for $6,200. That means you earned a profit of $1,200. Now to calculate return on investment, we need to divide net profit with investment cost. Excel will return 0.24. You can multiply it by 100, or just click in number section on percentage icon. Excel will format the value as 24%. That's it. You've just calculated return on investment. This metric is crucial for evaluating investments and comparing different opportunities. Remember, the higher the return on investment indicates a more profitable investment and better financial returns. If you found this video helpful, don't forget to like, comment, and subscribe for more Excel tutorials.
Hey everyone! In this video, I'll show you how to calculate profit margin in Excel quickly and easily. Firstly, we need to calculate profit. To do this, subtract the cost, which represents the total expenses, from the revenue. This will give us the actual earnings after covering all expenses. Once the formula is applied, drag the fill handle down to extend the calculation across multiple rows effortlessly. Next, we calculate the profit margin. To do this, divide the profit by the revenue. This will give us a decimal value 0.4. To convert this into a percentage, simply click on the % button in the toolbar, and Excel will format it automatically. This percentage shows us how much of the revenue remains as profit after all expenses have been deducted. A 40% profit margin means that for every $1 of revenue, 40 cents is profit after covering all costs. The higher the margin, the more efficiently the business is operating. And that's it, you've successfully calculated profit margin in Excel. If you found this helpful, drop a comment below, hit the like button, and subscribe for more Excel tips.
Hey everyone! In today's video, I'm going to show you how to calculate weighted average cost of capital. Before we start calculating, these are the data points we need for the formula. Equity, the market value of the company's equity. Debt, the market value of the company's outstanding debt. Cost of equity, the expected return required by shareholders. Cost of debt, the interest rate the company pays on its debt. And tax rate. Now that we have our inputs, the next step is to calculate the company's total capital, which is simply the sum of equity and debt. Now that we have the total capital, we can calculate the weight of equity and weight of debt. This shows how much each contributes to the company's financing. To find this, we simply divide equity by total capital. Same idea here, we divide debt by total capital. After entering both formulas, select the cells and click the percentage icon in the toolbar to format them as percentages. Now let's take a look at the formula we're using to calculate weighted average cost of capital. B4 multiplied by B8. This multiplies the cost of equity by the weight of equity. In our example, that's 12% times 67%, which gives us the equity portion of weighted average cost of capital. Plus. Next, we take B5, which is the cost of debt, and multiply it by 1 minus B6, where B6 is the tax rate. Then we multiply that by B9, which is the weight of debt. That means we're taking the cost of debt, adjusting it for taxes using the tax rate, and then weighting it by the proportion of debt in the capital structure. This gives us the after-tax debt portion of the weighted average cost of capital. And the result is 9.5%, which tells us something very important. This means the company needs to earn at least 9.5% return on its investments to cover the cost of financing from both equity and debt holders. In other words, any project or investment the company takes on should ideally deliver a return higher than 9.5%. Otherwise, it's not creating value. And that's it. Now you know how to calculate the weighted average cost of capital in Excel, step by step, from the required inputs all the way to interpreting the final result. If you found this helpful, don't forget to like, subscribe, and hit the notification bell so you don't miss any upcoming Excel finance videos.
Hey everyone! In today's video, I'm going to show you how to use the FE function in Excel to calculate the future value of your investments. Initial investment. This is the starting amount you invest. Interest rate 6% annually. Monthly payment. The regular monthly payment you make into the investment. For this example, it's €100. Months, 96. The total number of periods for which you will make these payments. To calculate the future value in Excel, use the FE function with the following formula. First, rate is interest rate per period. In this case, for monthly compounding, you would use 6%/12 months. NPR, the total number of payment periods, which is 96 months. PMT is payment amount per period, which is minus 100, use a negative sign because it represents an outflow of money. PV, the present value, or initial investment, which is minus 25,000, negative because it's an outgoing payment. Type is timing of the payment, which defaults to 0 for the end of the period, but can be set to 1 for the beginning. As a result, we received amount of money we would have after 96 months. If the result is currently displayed in pounds, but you want it in euros, you can easily change the formatting in Excel. Right-click on cell, choose Format Cell, and in category currency you can choose which you want. To explore how changes to your inputs affect the future value, adjust the initial investment, interest rate, or number of months. By tweaking these inputs, you can see real-time changes in the future value calculated by the formula, helping you explore different financial scenarios. And that's all for this video. Thanks for watching. Don't forget to like, subscribe, and comment.
Hey everyone, in today's video, I'll show you how to calculate sales growth in Excel. To calculate the sales growth, we use this simple formula. This subtracts last year's sales from this year's, then divides by last year's sales to get the growth rate. Once you get the result, click the % button in the Excel ribbon to format the cell as a percentage. Click on the bottom right corner of that cell. Click and drag it down to automatically apply the formula to the rest of the rows. Excel will adjust the formula for each year, so you get the correct sales growth between each period. You can also add conditional formatting to highlight high or low growth periods, green for good growth, red for decline. And that's it. You've just learned how to calculate sales growth in Excel quickly and clearly. If you found this helpful, don't forget to like, subscribe, and hit the notification bell for more Excel tips and tutorials.
Hey everyone. In today's video, I'm going to show you how to perform a break-even analysis in Excel. Let's start by understanding what break-even analysis is. The break-even point is where your total revenue equals your total costs. At this point, you're not making a profit, but you're not losing money either. The formula to calculate break-even is simple. Firstly, we need to calculate profit per one shirt by subtracting selling price minus variable cost. Next, we divide fixed costs by profit. And we receive value of t-shirts we need to sell to break even. It's not round numbers, so we can round it. And then we can check if it's true by multiplying break even with profit. We receive $2,010. This means we need to sell 134 shirts to cover our fixed costs, like our monthly rent. If you found this tutorial helpful, be sure to like, subscribe, and leave a comment below. Hey everyone. In today's video, we'll learn how to calculate the debt-to-equity ratio in Excel. The debt-to-equity ratio is a measure of a company's financial leverage. It shows the proportion of debt used to finance the company's assets relative to the shareholders' equity. Let's walk through an example. Assume we have a company with total debt of 500,000 euros and total equity of 250,000 euros. We need to divide these two numbers to get debt-to-equity ratio. Press Enter, and Excel will return 2. This means that for every euro of equity, the company has 2 euros in debt. This indicates a relatively high level of debt compared to equity, suggesting higher financial leverage and potentially higher risk. A higher ratio indicates higher financial risk, as the company relies more on borrowed funds. A lower ratio indicates a stronger financial position with less reliance on debt. And that's how you calculate the debt-to-equity ratio in Excel. If you found this video helpful, don't forget to like, subscribe. Hey everyone. In today's video I'm going to show you awesome Excel function, period duration. This function is perfect for anyone working with finance or investment calculations, and it's super simple to use. It calculates the time required for an investment to grow to a specific value based on a constant interest rate. For this example, we have initial investment 20,000 euros, and we want to calculate how long it's gonna take to reach 100,000 with 5% annual return. Type equals P duration. Firstly, we need to select rate, which is our annual return 5%. Then we need to select present value, which is starting amount of the investment. And last, future value, that is the amount you want to achieve. In this example, it's 100,000 euros. As a result, we received the number of years it would take to reach 100,000 with 5% annual return. We can change annual return to see how it affects the number of years needed to reach your financial goal. And that's all for this video. Thanks for watching, and I hope you found it helpful. Don't forget to like, subscribe, and hit that notification bell for more Excel tips and tutorials. Hey everyone! In today's video, we'll learn how to calculate dividend yield in Excel. Dividend yield is a financial ratio that shows how much cash an investor receives from dividends relative to the market price of a stock. It's expressed as a percentage and helps investors understand the return they're getting from dividends alone, apart from any changes in stock price. To calculate the dividend yield, we divide annual dividends per share by market price per share. Then we need to format result as percentage. Click the percentage icon in the number group on the Home tab. A dividend yield of 5% means that for every dollar invested in the stock, an investor can expect to earn 5 cents in dividends annually. This is a helpful metric for comparing the income potential of different stocks and making informed investment decisions. And that's how you calculate dividend yield in Excel. It's a simple but powerful tool for evaluating investment income. If you found this video helpful, don't forget to like, subscribe. Hey everyone! Today, we'll cover turnover ratio. This ratio measures how many times a company sells and replaces its inventory over a given period. To calculate it, we need those data: total cost of producing goods sold during a period, value of inventory at the start of the period and end of the period, and average value of inventory over the period. Firstly, we need to calculate average inventory by summing begin and end inventory, and then dividing by 2. Next, to calculate turnover ratio, divide the cost of goods sold by the average inventory. Excel will return 6.67, which means the inventory turned over approximately 6.67 times during the period. A high ratio means the company is selling inventory quickly, which is great for cash flow and reducing storage costs. However, an excessively high ratio could indicate understocking and potential lost sales. On the other hand, a low ratio might suggest overstocking, poor sales, or outdated inventory. If you enjoyed this tutorial, please give it a thumbs up, subscribe to the channel.
Hey everyone! In this video, I'll show you how to calculate net profit in Excel. To calculate net profit, subtract the total expenses from the total revenue to get the actual earnings after covering all costs. To apply the formula to multiple rows, drag the fill handle down, and Excel will automatically compute the net profit for each one. That's it. Now you can calculate net profit in Excel easily. Let me know in the comments if this helped, and don't forget to like and subscribe for more Excel tips.
Hey everyone, in today's video, I'll show you how to calculate the internal rate of return. The internal rate of return is expressed as a percentage and shows the expected annualized return on an investment. For this example, let's assume our project required an initial investment of 10,000 euros, which is recorded as a negative cash flow. In the following years, we had actual cash inflows. Select an empty cell and type equals IRR, then select range of cells containing your cash flows. Press enter, and Excel will return a percentage. This percentage tells us the annualized rate of return for the investment. If the internal rate of return is higher than our required rate of return or cost of capital, it indicates that the project is likely profitable. If it's lower, the project may not meet our investment criteria. To show more decimal places, click the Increase Decimal button under the Home tab in the Number group. You can change the cash flows in the cells to see how the IRR percentage updates automatically. And that's all for this video. Thanks for watching, and don't forget to like and subscribe for more Excel tutorials. Hey everyone! Today, I'm going to show you how to use the NPV function in Excel to calculate the net present value for a real-life example. We'll analyze cash flows over 10 years to determine if an investment is worth it. The discount rate, return of requirement, is set to 10%. Click on a blank cell where you want the result. Enter the formula equals NPV. Firstly, select rate, which is in our example 10%, then range of cash flows over 10 years. Press enter, and Excel will calculate the NPV for these cash flows. NPV is all about the time value of money. This principle tells us that money today is worth more than the same amount in the future because it can be invested to earn returns. By discounting future cash flows back to their present value, NPV helps us see the value of an investment in today's terms. A positive NPV means the investment generates more value than the cost of capital or the discount rate. In other words, it's expected to be profitable. A negative NPV means the project doesn't cover its cost of capital, so it might not be worth pursuing unless there are other strategic benefits.
Hey everyone! Today, I'm going to show you how to calculate compound interest in Excel. First, let's set up our data in Excel. For this example, let's assume we start with 1,000 euros. Next, we enter our annual interest rate. This is the percentage we earn per year. Now, let's enter how long we want to invest or save. We'll calculate the growth over 10 years. In cell B5, let's enter how often it's compounded. If interest is compounded quarterly, we enter 4. Now, move to empty cell and start typing the formula. B2. This is our initial investment. Next, enter an opening bracket followed by 1 plus. This ensures that each compounding period includes both the original balance and the interest earned. Then, divide the interest rate by the compounding frequency. Close the bracket and raise it to the power symbol caret. Inside another set of brackets, type B5B4, which calculates the total number of compounding periods. Finally, hit enter, and Excel will calculate the future value of your investment. You can now try changing the values to see how Excel automatically updates the future value based on different initial investments, interest rates, time periods, and compounding frequencies. And that's all for this video. If you found this tutorial helpful, don't forget to like, subscribe, and leave a comment below.
Hey everyone! Today I will show you PMT function in Excel. The PMT function calculates the payment for a loan based on constant payments and a constant interest rate. This is incredibly useful for loans like car loans, mortgages, or student loans. Let's say you're taking out a loan of $200,000 to be repaid over 25 years at an annual interest rate of 6.5%, and you want to calculate the monthly payment. Now, let's apply the formula. Click on an empty cell and type equals PMT. First, we need to select our rate, and we need to divide annual rate by 12 months. Then we select total number of payment periods, so 25 years, and multiply it by 12. Next, we select present value or the loan amount. And then hit enter, and Excel will calculate our monthly payment. It's negative because it's an outflow, money we gonna pay each month for 25 years to repay this loan. And that's it. You now know how to use the PMT function in Excel to calculate loan payments. This is a powerful tool for managing finances and understanding loans better. If you found this tutorial helpful, don't forget to like this video, subscribe to the channel, and hit the bell icon for more Excel tips and tricks. Hey everyone! In today's video, we'll learn how to calculate sum of years digits depreciation in Excel. This is a method used to calculate depreciation where assets lose more value in earlier years compared to later ones. Let's go through an example to see how it works. Cost is the purchase price of the asset, such as the price we paid for our car. Salvage value is the estimated value of the asset at the end of its useful life. For example, after 5 years, our car is expected to have a salvage value of $1,000. Useful life refers to the number of years over which we expect to use the asset. In this case, the useful life of our car is 5 years. Period refers to the specific year during the asset's useful life for which we are calculating the depreciation. So our syntax looks like this. Firstly, select cost. Next, salvage value, life, and period. We've already calculated the depreciation for the first period, and it's $3,000. This means that for the first year, the car loses $3,000 of its value. To find the value of the car after the first year, subtract depreciation from the initial cost. And we receive value of our car as $7,000 after 1 year. Now, let's calculate the depreciation for the second period. This means that for the second year, the car loses $2,400 of its value. So, after the second year, the car is worth $4,600. This explanation shows that the depreciation amount for each year decreases over time as the asset ages. The first year had a higher depreciation, $3,000, while the second year has a lower depreciation amount, $2,400, because it's calculated based on the remaining value. If you found this video helpful, please like, subscribe, and stay tuned for more tutorials.
Hey everyone! In this video, I'll show you how to calculate return on assets in Excel. It's an important financial ratio that helps measure how efficiently a company is using its assets to generate profit. To calculate return on assets, we divide net income by total assets. And Excel will calculate the return on assets. Now click on the cell and drag the fill handle down to apply the formula to the other rows. Let's format the values for better readability. Go to the number format menu and choose percentage. Now the values are easier to read. Now we can compare the companies. If one company has a higher return on assets, it means they are better at using their assets to generate profit. To make this easier to understand, we can create a bar chart. Select the company names and values, click on Insert, and select Bar Chart. And that's it. We've successfully calculated return on assets in Excel and created a chart for easy analysis. If you found this video helpful, don't forget to like, subscribe, and comment below on what financial ratios you'd like to see next.
Hey everyone! In today's video, we're diving into earnings per share, a key financial metric used to assess a company's profitability. Earnings per share represents the portion of a company's profit allocated to each outstanding share of common stock. Let's look at an example. We have here the net income our company had during the period, which is 500,000 euros. We also have the preferred dividends paid out, which amount to 20,000 euros. Average outstanding shares represent the average number of shares owned by shareholders during the period. Formula looks like this. Subtract net income from preferred dividends, then divides that result by the average outstanding shares to calculate the earnings per share. Excel will return €4.80. This indicates that for each share, the company earned €4.80 after paying preferred dividends. A higher earnings per share often indicates that a company is more profitable and potentially a better investment. Earnings per share growth over time can indicate positive company performance and is often a factor in stock price movements. And that's all for today's video. If you found this video helpful, please give it a thumbs up, subscribe to the channel,